what is accelerated depreciation and what is cost segregation and how that plays in for a real estate investor.
Yeah, I can. So cost segregation, there's a lot of stuff out there on BiggerPockets and a lot of information about cost segregation. And so it's always good to understand it kind of in layman's terms, which is very helpful. But cost segregation is kind of what accelerated depreciation is, and I'll kind of give you some history. Cost segregation has been around since the 1940s. And in some capacity, and how it started, it wasn't just like a rule that was made. It was actually created by real estate investors who were, in the 40s saying, why should I have to depreciate this building? Back then in the 40s, they were depreciating over 31 years or even 20 years or something like that. But the tax rules have changed. But they would come and they would say, why should I depreciate my building over, 39 years or 30 years or whatever the depreciation rate is in that tax year, when there's no component of that building that's going to last that long? Your carpeting is not going to last 27 years. Right. Even a roof isn't going to last, say, 27 or 39 years. And so there was this argument, and so they would approach the IRS and the courts and said, hey, we don't think we should have to do this. We're going to do it our way, and then you can audit us and tell us, no, and then we're going to go to court over it. And these court cases were established. And so back in the 40s is when they originally started, when we can go back to the first court cases of that kind of started what we know now as cost segregation, because of there's been these pioneers in the real estate industry who have basically fought for our rights to be able to depreciate our building faster. And essentially what they're saying is, if you do a cost segregation study, which is going in and breaking down all the different components of that building. So you're breaking out what is carpeting, what is paint, what is walls, what's roof, HVAC system, plumbing, mechanical, electrical, all of that stuff, and you break it all down, then the IRS is going to allow you to depreciate those assets faster than that 39 or 27 and a half years, okay? So just like in the beginning of the analogy where we had the $1 million over 27 and a half years multifamily, we were depreciating $36,000. If you can depreciate some of those assets faster, then you get more write-offs up front, which is that form of accelerated depreciation. So essentially what's happening is IRS says, okay, since the CPAs don't know how to break down the buildings itself, they don't have the value, they won't be able to tell you how much the roof is worth, right? Then the IRS says, okay, we're going to allow you to do this cost segregation study if you have a building professional come in and break down the different components of the building, where they can break out the mechanical, the electrical, and plumbing. They understand how the building is constructed and whatnot, and then apply a value to it. Now, if you build a building, you have all those assets, but if you buy a building, you don't have those. And so essentially we go in from Engineer Tax Services, and we'll come in and perform that cost segregation study where we're breaking down all the components of the building. As a result of that, there will be components of those. And I'll give you some examples. Like, for instance, we're talking about multifamily. In the multifamily situation, if you have 6 units or if you have 60 units, you have a lot of kitchens and bathrooms. And like, for instance, in the kitchen, you have appliances, okay? And so I think everybody here should know that appliances get to be depreciated over 5 years, because that's what the IRS deems appliances to be, is a 5-year class life. And you'll hear me use that terminology of class life throughout the podcast. But what is very interesting is if you have a cost segregation study done, the IRS says if you have an engineer who actually breaks down the mechanical, electrical, and plumbing, then all of the mechanical, electrical, and plumbing that service those appliances can also go into a 5-year class life. So let me give you examples of that. If you have a garbage disposal, a dishwasher, a refrigerator, a range, a microwave, right? All of those things have dedicated electrical. So they have an electrical plug behind that microwave that is dedicated just for the microwave. You have one for the range, the dishwasher, all those things. So that's electrical all the way back to the meter or the box, the breaker box. can also be taken in 5-year asset along with those appliances. The problem is a lot of people can't break out how much electrical lines there are from that to the breaker box, okay? And so that's where the engineering company comes into play to break that down. But the IRS does say that you can indeed take that. Same thing with plumbing. You have the water lines that go from the garbage disposal to the dishwasher, or the dishwasher, the sink to the refrigerator. All of those plumbing lines, and the same thing with the drainage, all of that can go into a 5-year class life. So those are just some brief examples of what the IRS, if you didn't do the cost seg study, those assets would be depreciated over 27 and a half years instead of the 5 years that you're allowed. But you just have to have that study done in order to substantiate what belongs where.
Got it. Well, thanks for that explanation. Let me see if I can try to, summarize that. So like the traditional linear depreciation is, over a set course of time, let's say, 39 years, you get to depreciate the exact same amount every year. But then since a lot of the components will not last 39 years, we made this accelerated depreciation where some parts of the building can be depreciated on a shorter schedule. Instead of 39 years, we might schedule some depreciation for 5 years and others for 15 years so that we can depreciate larger amounts in the first, say 2, 3, 4 years. Does that sound about right?
Yeah, that's good. And so like there's different class lives. There's basically a 3, a 5, 7, 15, and then your longer class lives that you can essentially break into. Most of the categories come in a 5, 7, or 15 year. 15-year class life would be something like exterior building components like gravel, landscaping, plants, trees, curbings, gutters, signage, anything outside the building, driveways, sidewalks, that kind of stuff that you might own. All of that can get placed into a 15-year class life. So those are just some examples of how that works.
Got it. So let's try to put some numbers behind this. So traditionally, let's say the $1 million building, the investor can deduct $36,000 per year. But with cost segregation, the owner can deduct a lot more, especially in the earlier years. It could be maybe 100,000 a year or even more. And some of that deduction can be applied for future income or even past income. Is that right?
Yeah. So the way it breaks down is let's just say hypothetically 25. I'm just going to do some quick numbers real quick. So you say you have that same $1 million multifamily building, you would be depreciating $36,000. If you did a cost seg study, you end up, let's just say on average, we get about 25% in a 5-year class life. So that's $250,000. And then we'll take another $100,000, which is 10% into maybe a 15-year class life. Okay, so total you have 25% and 10% that are placed into 5 and 15 years. So that means that the $250,000 that goes into the 5-year bucket, which is 25%, that $250,000 gets depreciated over 5 years because that's the 5-year class life. So if you take that $250,000 and you divide that by 5, essentially you're taking just in the 5-year, you're taking $50,000 a year for 5 years. Okay, so we will keep that number in mind. And then you have another $100,000, which is the 15-year class life, and you divide that by 15, you take another $6,700 there. Okay, and then that leaves, let's say, between the $250,000 and the $100,000, that's $350,000. So that leaves $650,000 left over that stays in the long time class life. So you divide that by, again, 27.5, and then you get another $23,000 there. So rough numbers. There's a double declining balance and in tax, and I don't want to get too taxy, but rough numbers. If you take the $23,000 of your long-term class life, you add that to your $6,700 for your 15-year, you add that to the $50,000 for each of the 5 years. Now, in basically from year 1 to year 5, you get to depreciate $80,000 in every year for the first 5 years, right? So you have more. Instead of $36,000, you have $80,000. So now, if that $1 million building was yielding you we talked about $50,000, but that's kind of low for $1 million building. Let's say you had, cash flows, maybe your cash flows were 100,000, right? Or maybe they were 80,000. You basically just write off all of the income that you made on that property with your depreciation in the first 5 years. You don't pay tax. All that money that you saved on the tax. Now, let's say if you have an $80,000 write-off, and let's say you're at a 40% tax rate, that's about $32,000 in tax savings, cash money. So that $32,000 over the course of 5 years, if you build that up, now you have enough down payment to go buy another building, right? So you're kind of saving that taxes because you're using that depreciation. And that's essentially the reality of cost segregation, or this accelerated depreciation that we're talking about.
And that is phenomenal. And I would, I'm going to go out on a limb and say a lot of the commercial buildings, like apartments, the investment horizon is a little bit shorter. It's typical for it to be about 5 years. So if you can do cost segregation and write off all the profits, and then you sell the property, buy a new one, you do it all over again.
Mm-hmm. Yeah, and there are some things that there is something that's called recapture.
Right.
Recapture is essentially you're accelerating your depreciation to a certain point, and if you sell that building, if you don't retire off those assets, then you have to pay recapture on that asset. But there's ways around that. I mean, we have 1031 exchanges, which I'm sure you all know about, that would offset any of the tax gain. There's also what we're doing now is, instead of doing a 1031 exchange, it's not a bad idea that if you're going to sell a property and you're going to upgrade into something bigger with higher cash flow, that you're ultimately going to take that. You sell the property that you're getting rid of, and then you buy another property in the same tax year. Then you can use the bonus depreciation from the new property to offset the capital gains on the old property without doing a 1031 exchange, and still forego the tax. We haven't really got into bonus depreciation yet, and I think that's your next question. So,
yeah,
I might have let the cat out of the bag there, but
no, let's talk about bonus depreciation. Let's what is it?
Yeah, so we've gone from straight line depreciation to our accelerated depreciation, which is essentially the cost segregation. And now I'm going to sound like an infomercial because I say, wait, there's more. So bonus depreciation is pretty exciting because so if you ran with me with the calculations, we ended up having $250,000 in a 5-year asset. We had $100,000 in our $1 million example for 15-year property. Okay, and so that was a total depreciation, accelerated depreciation of about $350,000 out of that $1 million building. Okay. So in 2006, George Bush introduced what was called bonus depreciation. So it's been around for quite some time and has just kind of gotten better over the years. And instead of going through the history of it, I'll basically just tell you what it is now. So it's kind of morphed. Jump starting in 2018, when we had the Tax Cuts and Jobs Act, President Trump ended up increasing the bonus depreciation and also expanding it. So it was limited to new construction or improvements. He opened it up to purchases and then increased it from 50% to 100%. What that means is that instead of having to depreciate that $350,000 over the course of 5 and 15 years, like we had talked about, the bonus depreciation means that anything that you reclassify into a faster class life, so these 5 and 15-year class lives, anything that's less than 20 years gets to be depreciated all in 1 year, the first year. And so what this means is that if you go buy a building, let's say I buy a building today, we're at the end of the year. If I didn't do a cost seg study on this building, I would depreciate a very small amount, because not only would you have to take that $1 million and depreciate it over 27 and a half years, but you'd only get 1 month of the 12 months of the year. Okay, so you'd have a couple $1,000s is all in depreciation. But by applying cost segregation and bonus depreciation, the bonus depreciation says that if you did the cost seg and the results of the cost seg were this $350,000, then essentially that $350,000 is a 1-year write-off. So you get to take a $350,000 deduction in year 1, even if I bought the building on December 31st. Okay, so you don't have to wait 5 or 15 years for the class lives. With the bonus depreciation, you get to take it all in that 1 year. Now, the next question is, what if my income is only $100,000 and, then I have this $350,000 write-off? Well, basically, you're going to use that for 3.5 years. You'll have $100,000 this year, then it rolls over whatever's left to the next year. You have $100,000 that year, and then $100,000 next year, and then you can use the leftover for the fourth year, that extra 50. So it does roll over if you don't use it. There was a question, and I don't know if you want me to answer this right now, but Art was asking about the question impacting the cost seg in regards to passive and non-passive income
Sure.
with carryovers. So I think it's important to address that. So we have, and I think you guys all kind of teach this whole concept of being a real estate professional. And if you can get to that status, then your real estate income goes from passive to active. Okay, so if you're a real estate professional, or if you're a broker or a real estate agent, or if you have a spouse that's in real estate, that you qualify for this real estate professional, then let's just say hypothetically, we've taken this same example of this $1 million building, multifamily. We did a cost seg. We got $350,000. We took that in bonus depreciation, but your income from this property was only $100,000. But if you're a real estate professional, which means that all of this income is active income, which also means that your deductions are active deductions, then this $350,000 would not only offset the $100,000 in income from the property, but it would also offset your wages. Let's say, for instance, you have somebody who's a doctor, right? Their main practice is a doctor, but their wife is a real estate professional. She goes and does a cost seg study on the building that she just purchased. That $350,000 loss, obviously she gets to write off all of the income from the building, which in this case was $100,000, but then she can take the extra $250 and she can offset her husband's wages because her income and losses are now active. Okay. So there becomes a very interesting strategy around when it's active and when it's non-active or when it's passive. I think that's really key in, deciding your tax planning and making sure that, knowing that the depreciation from real estate investing, if it's passive, then it's going to be locked up with passive, and you can only offset the income from that building or other buildings that you own. So you might own 3 buildings, and if you group them together, then you can take the losses from one and offset that cash flow. But you have to really plan that out. And it does matter whether that's, whether you're a passive investor or an active investor. So that's a very important question, Art. I appreciate you sending it.
Thanks for joining us today. You can find more episodes at therealworkshop.org.